Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking to discuss portfolio diversification in some detail. So just before we begin, if we can start, as we always do, with taking note of our disclaimer. Please do take a brief moment to familiarize yourself with the risks involved in trading the financial markets. Okay, so let's get straight into a webinar outline so you can have a good idea in terms of what you can expect over the course of this webinar. Well, we'll start with a very brief introduction to portfolio diversification. We'll just explain what it is and generally how it is applied by traders in these markets. Then we'll have a look at market access. If you're in a position where you are looking to diversify the trades that you look to take, obviously knowing what markets you can access is obviously going to be quite important. Then we look at the question really in terms of what to trade. One of the biggest issues a trader can have is being able to identify and narrow down the opportunities that need to be exploited. And there is a bit of a process involved in that. So we'll explain how to adopt an approach where you can really focus down on what it is you should be trading. We'll also look at correlated markets and how that impacts the whole approach to diversification. We'll also look at market availability. So you want to be able to know not just what markets you can possibly access out there. You actually want to know, depending on which brokerage you're currently trading with, what is the availability on a MetaTrader 4 platform, for example, and we'll look at what we actually trade in terms of the markets that we look at, which we do look at plenty markets. But like, for example, in our Institutional Traders Live or Active Traders Live, we focus on a number of different markets, and we can just touch upon what those markets are and why we trade them. And then we'll just put forward a truly diversified portfolio example so you can hopefully benefit from that. And we'll just finish with some do's and don'ts. Okay, so that's what you can expect. So let's get straight into an introduction to portfolio diversification. So when we talk about portfolio diversification, what it is effectively is an additional tool which can be used to assist the trader in their ability to effectively manage risk. So it is when a trader looks to trade different markets from different asset classes, ultimately with a view to spread the risk amongst uncorrelated markets. So it works on the understanding that a trader has much greater opportunity for higher return if the trader spreads the downside risks across different markets rather than just trading one market with bigger size, for example. So it is a form of capital preservation, and we'll explain why that is the case very shortly. So really, when we talk about diversified portfolios or portfolio diversification, it achieves two things. It can help spread risk across different asset classes. The last thing you need as a trader is literally putting all your eggs into one basket and hoping that the outcome of that trade is positive in order for you to see a return. So it is a useful risk management tool that is used by consistently profitable traders. And the second thing is really that it increases the opportunity for greater returns as well. So you don't necessarily want to be focusing on an asset class like just, for example, the foreign exchange markets. If we are experiencing major bull or bear markets, perhaps in the oil markets or the gold market for that matter, or even the government bonds, whatever the case may be, sometimes you can find some fantastic opportunities in other markets, and it just opens you up to that possibility for much increased returns if you look beyond just one asset class. Okay, so before we delve a little bit more into portfolio diversification and how we apply it, what we would need to know and understand is what markets can we access as traders. So just starting from left to right, of course we can trade stocks which they're also referred to and known as equities or shares. Now, these are individual companies that, of course, you can invest into depending on the value of the share price and the expected future value of that, the performance of that particular company. And every jurisdiction has its stock markets, and of course, within that, you have different companies that you can delve into and look for value and look for a good investment, more of a longer term investment in stocks and shares. So in addition to your stocks, we've also got indices, and these are baskets of stocks. So if we're talking about the S&P 500 in the US, we're talking about a basket of the 500 best performing US companies. So it's by far the largest indice in the world. One of the reasons why the US markets are so influential is the size and the sheer capitalization of and performance of those companies. So market indices, you can actually trade the weighted price of these indices. So it takes into a whole variety of different factors on the performance of that index and the performance of those 500 different companies in one place. So we can absolutely trade global indices as well. So in addition to stocks and indices, we can also trade commodities. So this is anything that can be mined or harvested or extracted from this beautiful planet of ours. So we're talking about oil extraction and gold, and obviously the crops and anything that can be farmed effectively as well. So we could be talking about even produce and the dairy markets and meat and grains. So there's a whole myriad of different commodities which can all be traded on an exchange, on a global exchange, and we as traders can trade that price movement in those markets. So whatever the price of gold happens to be, any fluctuations in price, and we're able to conduct the analysis necessary to get involved in that market with the understanding that the price of gold is either going to move to the upside or to the downside, and we can obviously trade that price differential. So that's commodities. And then moving on to probably the biggest in terms of size and tradable volumes on a daily basis, we're talking about the foreign exchange market. So that's the exchange of one currency in exchange for the other. It is a serious multiple in terms of daily tradable volumes, putting all these other markets together. By far, the biggest market is the foreign exchange market. Now, we can also trade. So the other thing about foreign exchange markets is it's trading one currency with another. So I suppose the key behind trading foreign exchange is to identify strength versus weakness. Now, moving on to government bonds, this is a way for a government to generate additional revenue for expenditure and projects on capital projects, for example, and a whole variety of for other reasons as well. So that government will issue you a bond in exchange for the capital invested, and what you will do is you'll obviously get a paper. And you will receive an interest return on that capital. So they'll give you back your capital plus an interest payment, and obviously therefore is a viable option for many global institutions and things like that. So in addition to government bonds, and we can obviously trade the price of these bonds if we're talking about on a MetaTrader 4 platform. So whether the price of bonds move to the upside or to the downside, we as traders are able to capitalize on that. And then finally, cryptocurrencies. So we've probably we're all very aware now of the cryptocurrency boom, which we've experienced certainly over the last year or so. And we're talking about cryptocurrencies like Bitcoin or Litecoin, and there is a large number of different types of cryptocurrencies, which of course can be traded, and we'll look at them shortly. Okay, so those are all the markets that can be accessed. So really, we need to decide, and we have many, many markets to choose from, literally thousands of markets that can be traded. We have to ask ourselves a very important question. What markets should we trade? So this is, of course, therefore, one of the most important and actually one of the most difficult decisions a trader can make. Obviously, if you get it wrong, you're dealing with regret. You know, if you're looking at a market and you get distracted and you're looking for opportunities elsewhere, and a market absolutely explodes either to the upside or to the downside, then you've got to deal with the psychology of that particular move as well. So obviously, very, very important. You don't want to miss those really, really good opportunities when they come around, because you may have to apply a little bit of patience and really take your time and look to cherry pick some opportunities. So as a result, then you're going to need to develop a method to assist you with trade selection. So you need to define a way in which you can decide which markets you should be trading, and perhaps which markets may not give you the opportunities that you're looking for. And a lot of this comes with experience, but one very, very useful methodology that can be used is multi-time frame analysis. So if you do have an understanding of how the markets perform on bigger time frames, it's a process of elimination. You can see if the market is performing, if it's moving to the upside or to the downside, and you are able to sort of deduce and come to a conclusion that some markets are actually potentially worth monitoring more so than others. So multi-time frame analysis is something. So if you happen to be trading an hourly chart, for example, you might want to look at the daily time frame and see what's going on in the bigger picture, or even weekly, and see, really zoom out of the time frame in which you're focusing, and see that bigger picture. And sometimes you get a certain degree of clarity as well, and you can feel reassured that the markets that you're looking at are actually the right markets we should be focusing on. So it is a useful tool that can be used, and do try to embrace the power of diversification as well. It can be a powerful tool. Like I alluded to earlier, we might be trading foreign exchange markets, we might be trading global indices, and we might be trading a really massive move in the gold or the oil markets, for example, on the commodity side. So it just opens up those potential opportunities across the board. Like in 2014, we saw a massive decline in the oil markets, from roughly $100 down to $28 per barrel, and now we're seeing the reverse. Over the last 6 to 8 months, we've seen a move from those lows of $28, and now we're approaching the $70 mark. So you see these major market moves, and they ebb and flow. They move to the upside and they move to the downside. And if you are truly diversified in your approach, not just perhaps focusing on one particular asset class and trading 2 or 3 markets within that, of course, that is an individual choice for each trader to make. But if you are open to diversification, it can mean that you can capitalize on some major market moves across multi-assets. Okay, another just point to be aware of is be aware of correlated markets. So the principles of correlated markets work hand in hand with diversification. So just to define, it's a statistic that measures the degree to which 2 markets move in relation to each other. And this can be either positively, they can move in a positive manner, or they can move negatively as well. So it's very important to know, if you trade correlated markets, it can really impact your ability to generate consistent returns. So what many people don't necessarily realize is that if they happen to be looking for an opportunity to buy the oil markets, they may be looking across the foreign exchange markets and see a really, really good opportunity, perhaps in the dollar CAD, and they may not be aware that there is often a correlation between these 2 markets. So over a similar time period, you can see the oil markets moving from bottom left to top right, and you can actually experience a similar move where we're getting price action move from top left to bottom right. So we are getting and seeing that correlation in these two markets, even though it might not be necessarily evident to that particular trader that if they're trading these two markets in these directions, that they're actually trading correlated markets. And the problem with that is if you do it on purpose, there's no significant problem with that. It can be a little bit of a no-brainer decision to make on occasion, but the problem comes if you're not aware of that correlation. If you happen to be buying the oil markets and you happen to be selling the dollar CAD, then what that can do is if we get a push to the upside in the oil and the dollar CAD sells off, you have the potential to double your profits. The problem occurs if you're unwittingly trading correlated markets is when the markets move against you, because effectively what you're doing is doubling your losses as a result. So it's just very important to be aware of correlated markets. So to just give you just a brief understanding of some other correlated markets, of course, the prices of oil, for example, moving to the upside, you're likely to see the Canadian dollar strengthen as a result, and vice versa. If the prices of oil move to the downside, you're likely to see the Canadian dollar also move to the downside. And the reason is oil is one of Canada's major exports. So the economy is dependent on that price of oil. So if the price of oil goes up, the Canadian economy will benefit accordingly. And if the price of oil goes down, it's likely to be impacted adversely as well. And you'll be able to see that in their currency. So in addition to oil and the Canadian dollar, we also have the US dollar, and it's correlated negatively with the gold market, for example. So and the other sort of slightly confusing aspect of correlated markets is they don't necessarily need to move in tandem. And in fact, on occasion, you can go through periods where there's news events that occur that impact one side of this equation. So they can go through a period where they actually move independently before falling back into correlation. So you get and a lot of this will come with experience as well, but you'll get to know and understand when markets move in a correlated fashion because you can see it in other markets. So, for example, if the price of the US dollar strengthens and moves to the upside, you're very likely to see gold move to the downside. And also with regards to trading markets like the euro dollar, the pound dollar, the Aussie dollar, and what you often find is traders, especially when they're new and inexperienced, they can trade these markets unwittingly. So they can be looking to buy the euro dollar, the pound dollar, and the Aussie dollar, not necessarily knowing that if the dollar strengthens, then all of those three markets are very likely to move to the downside because they're all correlated with each other. And the common denominator is the dollar part of these currency pairs. So of course, if the dollar strengthens, the euro dollar will move to the downside, the pound dollar will move to the downside, and the Aussie dollar is very likely to move to the downside, and also vice versa. So this is okay. You can trade those markets if you understand that they are correlated. The problem comes is if you happen to be trading these three markets at the same time, not knowing these markets are correlated, and what you'll experience is potentially a strengthening of the US dollar. You happen to be buying these three markets, and all you're effectively doing is tripling your losses to the downside. So just be careful. And that's really the point that we want to make regarding correlated markets. Just be mindful when trading that you do understand the impact that correlated markets can have on your ability to generate consistent returns. Now, a quote I would like to share with you is that pride of opinion has been responsible for the downfall of more men on Wall Street than any other factor. So this is a well-known quote by Charles Henry Dow, who is responsible for the Dow Jones Industrial Average and as well the Wall Street Journal. So he knew a thing or two about trading these financial markets. And I suppose the point is that would be the equivalent of a trader in a very stupid, or should I say reckless and careless fashion, a trader looking to buy the dollar and sell the gold market. Let's say the opposite to that. Let's say they're buying the dollar market, and they are also buying the gold market. Well, the likelihood is they're going to cancel each other out. And what we don't want to do is expose ourselves adversely if that correlation detached somewhat, then you can find yourself well offside. And it's just important to bear that in mind, that there is these correlated markets. They can defy logic and even common sense at times. So it's very important that you do have mental dexterity when you trade these financial markets. And just because you have a really strongly held opinion, it doesn't necessarily the markets are going to follow through. And another quote as well, just to share with you, is that the markets can remain often illogical far longer than you or I or any bank or any institution can remain solvent. And that's really, really important as well. So that just shows the importance of something like really effective risk management. And portfolio diversification absolutely plays its role, and so does the understanding of correlated markets within that. So so hopefully that makes sense. So moving on then to the MetaTrader 4 market availability, for example. So let's see what markets can be offered through certainly a MetaTrader 4 platform. And where you will locate all of this information is in two places. Firstly, the Market Watch. So we can see they're all color coded. We can see the blue represent currency markets, and there's majors. We've also got some minor currency markets there in green, and we've also got exotic markets currently on the left hand side. And if we slide the way through, we also have global indices in this kind of darker red, and then we start moving in to things like the dollar index, and we have a series of individual markets, company shares and equities. So things like Apple, Amazon, Cisco, eBay, Google, all of these major, IBM. So all of these major, these are obviously US, Microsoft, Netflix. So you have a whole variety of different asset classes all available to you, more currencies. We have some commodities in here as well. And we have a whole series of additional equities as well that can be traded. And just at the bottom here, we have a whole number of cryptocurrency markets as well. So as you can see, there's a large number of different opportunities available. And this is just one brokerage and one selection of markets. Another place for you to find a more concise overview of the accessibility of the markets that are available to you would simply be going to view and click down on symbols, and you'll be able to see the variety. Those are your majors that you can look to trade. You've got exotics in there as well, and a whole myriad of them. We have our indice markets, so there's plenty markets to be traded. We also have the dollar index. On the stock side, a large number of stocks available. We have FX crosses as well. So we have an extensive number of foreign exchange markets. The energy markets, so we're talking about natural gas and crude oil and Brent oil as well. On the metal side, we have obviously things like copper and silver and gold. So a whole variety of markets, and of course our crypto markets as well. So this is your Bitcoin and your Litecoins and things like that. And you can see there's quite a large array of markets, and these will all vary from brokerage to brokerage. So you might have slight variations or additional markets with some brokerages and less markets with others. So looking at market access and accessibility to the markets that you like to trade is also a very useful is a very useful thing to know. So that is just looking at the market availability on a MetaTrader 4 platform. So so those are all the different types of markets that can be offered. So what do we personally trade next is the question that we want to try and answer. So let's review the markets we focus on when we trade, and we're talking about during our institutional traders live every evening, or in the active traders live webinars during the day for the US Open. So where we can see these and focus on a bit more detail is just at the bottom here, where you have dollar index. So we want to trade the index of the dollar just to see what's going on in the dollar. And as you can see in recent price action, we've had a really explosive move to the upside, which I'm sure you are probably very, very aware of. Then we have other markets like the euro dollar. And just moving along the bottom, we have the pound dollar, the dollar yen, the dollar CAD, and the Aussie dollar, and the New Zealand dollar, and the dollar Swiss. So these 7 currencies are effectively the majors. So we can see how each of those currencies and economies perform against the US dollar. So the common denominator these 7 currencies have is the fact that they are paired with the US dollar. So we can use that to gauge strength and weakness and work out which markets are strong against the dollar and which markets are weak against the dollar. So they're very useful to have an understanding of the 7 largest currencies in the world, and know how they react and feed off each other from a price value perspective. So we can begin to trade strength versus weakness if we have an understanding of how these all perform with the US dollar. It's a good gauge to have. And then we have some minor currencies to choose from. So the euro pound, for example, we can see how the euro is performing against the British pound. And then we can look at other markets like the pound yen, the euro yen, and see how the yen being a flight to safety, we can see how it interacts with global indices. So a lot of these markets react and behave to the performance and the development of additional markets. And we also have our global indice markets. So this is where our diversification starts to kick in. So we've just reviewed a whole range of currencies. We're now looking at a number of global indices. So we have the S&P 500. We have we have 3 US global indice markets. So we have the S&P 500, the Dow Jones 30, and the Nasdaq 100. And they're just constituted with different companies of different size in different sectors as well. So they often act and move in a very, very similar fashion. So today now they're all very, very bullish, and they can perform like that. Same with the UK FTSE. So these are the FTSE, the 100 largest companies in the UK can be traded through the FTSE, and the performance of those companies can be traded through the FTSE, and the German as well, the German DAX, which is the German 30. So so those are our indice markets. We also have, so we've reviewed our currency markets. We've had a look through some of the global indice markets as well. So those are there for us to choose from. And we also have some commodity markets as well. So this is the gold market, and we also have the US oil markets. So they are moving in different directions. And on the Bitcoin side, we do monitor and look at Bitcoin. On the cryptocurrency side, should I say, we do look at Bitcoin, and you can see what's happening to price action there accordingly. So the point we're trying to make is we do want to look at the most liquid and global markets in the world. And we do that by diversifying, by looking at opportunities in a spectrum of markets, and not just literally focus on just a few like foreign exchange markets, for example. Okay, so that's just a little review of looking at some of the markets that we trade, certainly during our active traders live webinars every day, and also our institutional traders live webinars on a daily basis also. So moving on then to an example of a truly diversified portfolio, and the idea is to mitigate the negative impact trading correlated markets can have on our ability to be consistently profitable. So here we're talking about global indice markets like the DAX 30, for example, or the CAC 40, which is the French stock markets. So those are two European indice markets. You could then blend it and mix it with trading certain stocks. So for example, to keep it truly diversified, you might want to look at a US a company like Disney, for example, and you might want to compare and contrast it with a UK bank, for example, the HSBC, and you can see the diversification in there. And then in Europe, we might look at Telefonica, which is a telecommunications company. So all of a sudden, even within your ability to trade stocks, you're looking at diversifying across different sectors. Again, if the banking industry take a bit of a dive to the downside, you're not completely exposed in your capital and your risk. So you're spreading it across entertainment and also telecommunications. So it's all of these things start to come together when we talk about diversified portfolios. On the currency side, because we're trading individual stocks in the US, UK, and in Spain, and the global indice markets in Europe, we might decide to look at trading the Euro New Zealand, for example, or the pound yen, or the Aussie Swiss. So truly trying to keep the performance of this portfolio diversified as best we possibly can. In addition, we might look for some opportunities in the gold markets, in the metal markets, and in energies. We could be looking at crude oil and wheat or coffee if we're looking at the soft commodities. And just finally, with regards to the government bonds, we might want to integrate maybe the 10-year Italian bond as well. So that's just going through a process of looking to truly diversify the best way we can. And you might want to throw in a cryptocurrency like Bitcoin as well. So that is just an overview of a truly diversified portfolio. So let's just finish with just a few do's and don'ts with regards to portfolio diversification. Do look to spread your risk across different asset classes. Hopefully it just makes sense on a logical perspective. You know, we are aware that when traders become you know, more experienced, they absolutely can fine tune and they can select certain markets that they've got a really strong understanding about, and they do cherry pick and do decide to trade just a select number of markets. That's absolutely fine. However, don't necessarily deny yourself the opportunity to capitalize on like the gold market, for example, if there happens to be a major price move in there. Yeah, don't put all your eggs in one basket. There's no real need to do so, and that's what those that just focus on foreign exchange markets can do on occasion, and especially if they don't understand the correlation of certain markets, then they can be exposed to the downside. If you're truly interested in diversifying your portfolio and trading multiple markets and asset classes, then take an interest and become knowledgeable about the different asset classes and the markets that can be traded within those asset classes. So really give yourself the best opportunity to succeed. And unfortunately, when it comes to trading, especially if it's your hard-earned cash, there is no, ignorance is not a defense to any great extent. The reason why we say that is we've been hearing it far too often now, that I didn't know it was correlated, and I didn't know there was a relationship between one market and the other. So really, it's our job as traders to know what the markets we're looking to trade, looking at what they are correlated with. Do embrace multi-time frame analysis. It's a very useful skill to just have a look at the bigger picture and see what opportunities may exist. Look to build a truly diversified portfolio if you possibly can. Sometimes that's not overly possible, but as long as you're knowledgeable and aware of the correlation, you can then make decisions that best suit the performance of your portfolio. Be careful of correlated markets. Of course, only trade these if you mean to. I think that's really the point we'd like to get across, because on occasion, we can certainly look to trade correlated markets on purpose. It's only an issue if you happen to trade these markets without knowing that they're correlated. So understand the impact that also from a technical perspective that leverage and margin can have on your trading performance, because if you trade multi-asset classes, they all have varying access to leverage. So it's important to know how leverage can impact your trading positively and negatively, depending on which market and asset classes you're trading. And also the margin requirements for different markets in different asset classes can vary drastically as well. So, and all of these have the ultimate impact on your trading performance. So please do bear those things in mind as well. Okay, so just to review the webinar outline, we had an introduction to portfolio diversification. We looked at market access, to just discuss briefly what to trade and some of the things to consider, correlated markets, do's and don'ts. We had a look at MetaTrader 4 market availability, what we personally look to trade, and just providing you with a diversified portfolio example. So that just about concludes this particular course. So all that's left for me to do is to thank you very much for joining us. Do take care, and we look forward to seeing you next time. From everyone here, bye for now.